Hello, and welcome to Collier Bristow's US UK podcast, where I invite guests on to discuss topics that are common to the tax and estate planning world and may be of particular interest to Americans living in the UK. If you're a regular listener to the show, then you may be used to me asking this by now, but please do leave a rating or a review, hopefully a good one, wherever you're listening to this, because it really does help us. Today, we're going to think about life insurance, which is perhaps a topic that doesn't garner as much focus in estate planning as some other topics we've discussed, but for reasons we're about to go on to, is a really, really important part of an estate plan. I have the pleasure today of being joined by Christian Vandenhout, a senior private client advisor with V International. V are a UK-based firm of specialist US-UK financial advisors who are, at least in my experience, one of or the leading advisors on matters of US-UK life insurance planning. And it's a pleasure to invite him today. Christian, how are you today?
Great, Aidan. Thanks so much for having me on the show today. Yeah, I look forward to talking about all things US UK life insurance related.
An absolute pleasure. This is going to be a great discussion, I know. So, when we're thinking about life insurance, I appreciate this is something that you probably spend 99% of your waking day thinking about and probably spend 99% more time thinking about it than the rest of the population. So, you've probably got a very firm grasp on kind of what life insurance is, when we use it, what the consequences are, etc. And there'll be people listening to this episode who have a concept of life insurance. Maybe they've taken some out with the mortgage, or they're familiar with some of the big players in this field on the UK side. But what I want to get us looking at today, and particularly in the second half of this two-part episode, is thinking about some of the more sophisticated and clever and useful ways that life insurance comes into an estate plan, particularly for high net worth individuals. However, I think we need to start at the beginning, break down some of these concepts and terms into sort of slightly more digestible chunks, and think about what life insurance actually is. And so I kind of want to tee you up with that as a really broad question. What is life insurance from your perspective?
Sure, right. So, sort of life insurance 101. In the most simple form, life insurance is really sort of a risk mitigation, financial risk mitigation strategy where the client is paying in regular annual premiums into a policy to guarantee a larger death benefit should the individual die either during the term of a policy, if it's set for a finite number of years, let's say 10, 15, 20-year term, or if it's a permanent policy that's guaranteed to pay out when they ultimately die at any point. As with all things American and British, there are slight nuances and variations in language used. Life assurance versus insurance. So, assurance, the concept that it's going to pay out, insurance being more of a hedge against the potential outcome.
Oh, I've always used assurance and insurance, and people have used, and I've just tend to think, is it an American British thing? From your perspective, is that how you use it? Assurance would be it's guaranteed to pay out, or it's insurance it isn't.
In my mind, if something's, you're assured about something or you have the assurance, but you hear people in the UK
Yeah,
talking about assurance more. In the US, it's, something is insured, is
yeah.
insurance. But you've got with traditional life insurance, so this is really the more, I'm conscious we'll probably go in more detail, a lot more detail later on, but in the traditional insurance space, which concerns itself with a pure mortality benefit, and that's all that you're paying for, you've got term policies that last for a finite number of years to provide protection, as you mentioned, for things like income replacement, mortgage protection to cover kids' education, private school fees, things like that, where there's large liabilities and needs. And then on the other hand, you've got life insurance tends to be used more longer term for estate planning and really for the inheritance tax planning or US federal state tax planning down the line. And then you'll have planning opportunities in between those where it's often used to cover things like gifts or related to business planning. But I'll sort of stop there because I think we're going to come onto that later.
Yeah, in my non-life insurance advisor sort of brain, I always think of it as you might need some money in the future, or people after your death might need some money in the future, or after a particular event. Would it be helpful for you to have that money in the future? And do you have the means to pay for that money to arise in the future?
I think you're right. It's a helpful way of looking at it is it can be part of cash flow planning. Your holistic financial planning reviews and discussions with clients. And particularly if somebody's in their earlier stage of their careers, let's say their late 30s, early 40s and starting families, they are on the asset creation part of their journey. They still have many years of earnings ahead of them. They have high liabilities. Your point exactly, I think, is relevant there, which is if the worst happens, is your family or your children or future children going to be in a financially secure position? And from that perspective, I think of insurance as a little bit more along the lines of, let's say, your home insurance, or you're more of a general insurance where you're taking out something to cover a potential and frankly quite low probability outcome.
Yeah. Sometimes you take it out because of things that you don't know whether they're going to arise in the future. Sometimes you might take it out because you do know something's going to arise. Maybe you're the breadwinner, as you mentioned before. You're covering lots of earnings. You know that's going to happen, and so you want that cover. Sometimes it's tax may arise in the future, and so we want that protection. One thing you could do for me as well, and do for the audience, you will sometimes hear different terms used for different people within a particular product. So from my perspective as a lawyer, I will often, if I review a life insurance policy, you'll hear about the life assured, you'll hear about the policyholder, and you might hear about the beneficiary or the beneficiaries. These are sometimes the same people. These are sometimes the different people. I state as a statement, but I ask rhetorically, wanting it to be a question. You don't need to have the policyholder and or the life assured and or the beneficiary being different people. What will suit each family or in each circumstance is different, but often it's the life assured is the person we are talking about, the person on whose life this policy will turn.
Yep, that's correct. And that's generally how that plays out, where the client, the person who's coming to you or to us for this type of planning, they typically are going to be also end up being the measuring life of the policy. So what we say in the UK is the life assured, or in the US, you'd say the proposed insured. And then based on their own unique circumstances, you may have them owning the policy directly, but for reasons we'll come on to later on in the discussion, that's quite rare to be the case. You'd often have a trust act as policy owner and often also as the beneficiary. But you can have individuals acting as the policy owner directly, or a spouse or a family member, and also appoint individuals directly as the beneficiaries. So you can have different sort of permutations depending on the facts and circumstances.
That's helpful. I always have to kind of stop and remind myself when I'm looking at particularly an old life insurance document that maybe comes from a long time ago, because they'll use different terms. And I'm going, hang on, remind myself which one of these is the person who's the life assured and which one of these is the person who's the policyholder. I had to stop and reflect each time. Let's think about the process of taking life insurance. From the man on the street perspective, it's usually I go onto a comparison website, for example, and I find there are some competing interests based on some fairly generic metrics. But at a more sophisticated level, I'm aware, because you and I have had the pleasure of doing this together sometimes, it's a more involved process. So what does that process involve from your perspective as the advisor? What are the key points along that stage that clients need to be aware of, and what do each of those stages involve?
Sure. Yeah. So there's probably two main areas or two parts of the process that tend to take the most amount of time. The first is the medical underwriting aspect, and the second would be the trust drafting and creation part of the process, if that is happening, which it often does. But going back to the medical underwriting, so the first step will typically be the client will, unless they're taking out very small amounts of insurance where you can, known as accelerated medical underwriting, there can be very small amounts of cover which are made available without any underwriting, but that tends not to be relevant for the client that we're dealing with. So medical underwriting will typically include a brief exam, maybe 30, 45 minutes, with nothing too taxing, an EKG, no sort of treadmill, just a resting EKG, blood and urine sample, and your typical family history questionnaire and sort of health questions that you would have with any sort of new GP. And then in addition to that, it's slightly different between the US and the UK markets, but generally, and certainly with the US market, the insurers will want to see the last 5 years of medical records, which we would obtain on behalf of the client. At that point, the insurers will be able to simultaneously underwrite the medical risk that the individual, the proposed insurer, the client usually poses, At that point, yeah, there may be some follow-up questions. There could be the requirement for an additional test, but that's very rare. And at that point, the insurers will start to give tentative offers. They'll issue tentative risk ratings based on someone's medical profile. At this point, the heavy lifting's done. It's not guaranteed. It's still subject to a formal application, which includes other questions around your travel, lifestyle. But you have a lot of certainty as long as the clients have been open in the initial discussions, and you've gone through things like, do you have any risky avocations? Are you skydiving, cave diving, mountaineering, driving? Are you racing, classic cars on the weekends? Once you're comfortable that that you have that information and you know where they're traveling abroad, those can sometimes lead to people traveling to exotic countries regularly, then that may, more than just a 1 week or 2 week holiday, that can sometimes lead to additional questions. Once you're comfortable that you have that information and that's not going to pose any last minute concerns for the insurer, you go through the medical underwriting first. From the client's perspective, it's just an exam. Then the insurers negotiate through us, and we have some offers available. The client essentially has a confident feeling that they have a firmed up price of insurance at that point. Don't have the discussion around policy ownership and trust, etc.
With this sort of avoidance of doubt and to sort of finish off the circle from my perspective, the reason why the medical is so important is because the insurer is taking the risk on how much they're prepared to pay out relative to how long they think they're going to be able to take premiums from you, or what's the total amount of premium they want to take from you in order to cover the risk if you die prematurely. The earlier you die into a policy, the more likely it is that the insurer is going to lose out. And if you live way past your expected actuarial lifespan, the insurer has made money on you. Have I made it possibly too simple? But that's effectively what the insurance company is doing.
No, yeah. Look, it's insurance. So it's law of large numbers and averages. So the insurance companies have, in some cases, 100 plus years of mortality data. And frankly, and this data is also pooled and shared at a certain level where they will make an assessment on your risk, on your health and the mortality risk that you pose. And they'll take a decision based on publicly available information as well as their own internal tables as to how they can price that to be. It's the trying to find the balance of making offers that are competitive to win the business relative to their competitors, the other insurers, but also that if they win it, that on average, with enough insured clients, that pool of insureds will provide profit to the company, enough to cover their expenses and surplus for profits.
The house always wins, ultimately.
Well, from a sort of a business perspective, insurance companies are constantly reviewing the profitability of their products. So you will see quite frequent tweaks and changes in the cost of insurance for the same product. And also products get removed, get pulled from the market because insurance companies don't want to continue adding liabilities to their book.
Yeah. We had a client about 6 years ago, who was in his early 30s, and he was a wealthy individual. And I actually can't remember. Oh, no, it was gift insurance we were doing for him. And he was going through the medical underwriting process, and the questions that came back were, what do you like to do in your spare time? Exactly as you'd said. And he was listing us all the hobbies a young and wealthy man of 30 would like to do. And he explained that he likes to fly helicopters. And the comment came back, oh, so when did you obtain your helicopter flying license? He said, oh, no, I don't have one. And it was like, sort of, the new page of the form gets turned over. Right, okay, thank you. We'll note the lack of qualification on your helicopter flying lessons. I think his premiums went up by about 60 or 70% at that point, because that's the cost of wanting to fly your helicopters without a license, I guess. One thing you did mention there, I've always actually wondered, and I've never actually squared in my brain clearly. You reference insurance companies and you reference underwriting. What is underwriting, and how does it relate to the insurance company? And how do an insurance company and underwriter interact?
Yeah. So underwriting is simply the term used to describe the assessment of a risk. So an insurance company underwrites, in this case, the mortality risk posed by an individual. You could also use that sort of expression with, property and casualty insurers underwriting, home risk or hurricane risk or flood risk. It's the same concept. They're putting a price tag on it. So underwriters are employed in-house at insurance companies. So they are just a staff member of the insurer.
Fine. Okay. So when we talk about the underwriter or an underwriter, we're not talking about a separate body that's a third party referred to. It's one of the categories of people within the insurance company.
Within the insurance company. And what is interesting is insurance companies, I don't know if I've had this experience with a case that we've worked on together, but you'd be surprised at how often different insurance companies will come to different conclusions about the exact same medical file.
Mm-hmm. Mm-hmm.
So, which is why it's important to go out and, as an independent advisor, to approach multiple insurance companies that will have, or we know will have, suitable solutions for a client's needs, because we fully expect there to be some variations in the risk ratings that they offer. And sometimes more often it will be down to the fact that insurance companies look at or place different levels of emphasis on different health criteria or medical criteria. One I had during COVID was there was an increase we noticed in alcohol consumption, certainly by the end of COVID. And there were certain companies that looked at, I think it was called the CGT or GGT liver enzyme, which I had, at least with a couple of clients, lit up, so to speak, in the results for perhaps best described as overzealous alcohol consumption. And to the point that not only were they highly rated, they were declined. They were just rejected.
Really?
And I had other insurers giving them preferred rates because everything else about their health profile was very good. And other insurers simply did not look at that, weren't bothered by that specific reading. And it wasn't part of their test of blood results.
All right.
So you have different insurance companies that it's common to have different insurance companies give different assessments. And it's mainly, I would suspect, driven by how they interpret medical information slightly differently. But similarly, you can have insurers take a commercial decision to try to win business or expand their book of business. And if somebody's on the border between two categories, that's where, as us, our position as independent brokers, we can say, look, you would be our preferred carrier, but XYZ insurer has a better risk rating and a more attractive offer. Can you budge up and get to a higher rating to reduce the cost? And they can sometimes make that decision purely from a commercial position.
So you have several insurers you go to where you've got a client who's a heavy smoker, for example, which even I know is one of the number one questions that you guys ask us, or we have to ask our clients when they go for that process is, are you a smoker? So presumably there are those that are more geared towards that market, or those who just say, no, we're not going to insure anyone who has that level of risk, because it just kind of puts a massive red flag immediately on their profile.
Yeah, I mean, smoking that you mentioned there is one of the big ones that can, in some cases, depending on the age and category of the client, can almost sort of double the annual premiums for the insurance policy. But yeah, different insurance companies, you tend to understand, after a while, you get a feel for where their sweet spots are. Some insurers will be better at making offers for clients with slightly high cholesterol or blood pressure, some who've been in remission from cancer for X number of years. Different insurers will have different appetites for slightly different, clients with diabetes, things like that.
This is where I guess this is where I'm going to slightly softball you a question, which is, that is why I'm asking rhetorically again. I presume it is useful having an independent advisor in this process to help with that investigation, because you as an individual don't have, one, the same level of access, or two, the same level of experience in knowing how to scour the insurance markets to know where the best deals are. That is what V is there for in this particular part of the discussion.
Yeah, that's certainly one of the areas where we'll be able to provide some value add, is knowing which insurers are going to be in a position to offer both the products that are going to be suitable, because there's various different products and from different markets. We can talk about that later, but UK markets, US market, and indeed offshore markets, as well as how to take someone through the underwriting process, to guide them through that, so that there's no pitfalls, to ensure that they're taking out appropriate amount of cover, and also to give them a bit of a steer on the types of questions to consider around things like policy ownership, which would then dovetail back into your domain, which is usually includes sort of trust ownership.
Mm. So you did tee us up there, and I think one of the last things I want to come to before we head to a break is to pick up your point about different markets. So V are a specialist US UK advisory firm. That's why we have the pleasure of knowing each other. What is it that's special about the US market for insurance, and what is it that's particularly accessible for the American community living in London, and thus why they should know about the fact the American market exists?
Yeah, so if we are just looking at the thinking between the UK and the US life insurance market, the UK life insurance market is very good. It's widely available to UK residents. The US market is available to US residents, but also to individuals living overseas. And that can include both US citizens and also non-Americans, but with US financial ties. That opens up the US market. As you know, most of our clients are US citizens in the UK or typical Western European and international financial centers. And for those individuals, having a solution, a life insurance policy sourced from the US, so from a domestic US carrier, and designed in such a way and also structured, usually in a trust, such that is the design of the policy and the entity taking out the policy, holding the policy, is US and UK compliant, typically is going to produce the most robust solution overall. And to sort of break that down, number one, as a starting point, if you were to have an American with a UK arrangement, let's say your most simple solution, which is a UK policy from an Aviva or AIG or Royal London that is held in a UK trust, either one drafted by a lawyer or even just a complementary online trust that these insurance companies in the UK offer. Interesting difference here that those are not available and offered by normal process in the US.
Mm.
That insurance policy held in a UK trust is typically going to be within their US taxable estate, federal gross taxable estate. For most of our clients, their level of wealth is going to be over the US allowance and therefore tax-free allowance, and therefore that death benefit essentially is going to be subject to a 40% haircut.
Yep.
So from that perspective, for most of our clients, that's just not a good starting point. It totally changes the calculation and the returns. I don't want to go too much onto the tax side, but I suppose there's also additional compliance reporting costs for Americans having foreign trust-owned arrangements. So from a compliance perspective, suitability perspective, for Americans, a US source arrangement held in a trust that works for US and UK purposes, and I'm sure you'll go into that in more detail later, typically is going to be sort of the gold star way to set these up. Now, that's from a compliance and tax suitability perspective. There's also some more practical benefits, including the US market has a broader range of product offerings. So in the UK, we have here in this country basically term of whatever number of years you want, all the way up until a policy that's guaranteed to pay no matter how long you live, up until age 120. And they have no cash value. In the US, you also have term policies, typically sort of quinquennial, so 10, 15, 20, 30 are the typical durations that term policies are available in the US. And then you also have what I refer to as permanent life insurance. In the US, it's quite commonly referred to as cash value, which are policies that are guaranteed to pay out, last for someone's entire lifetime. And there are different variations there. And again, I think that's perhaps a topic to explore in more depth later. But if you have a US compliant policy, if your circumstances change, having a US compliant policy, there is an ability to exchange policies between either to another policy from the same insurance company, which is a non-taxable and sort of a non-chargeable event from the US perspective, known as a 1035 exchange. We're seeing quite a lot of that at the moment. there are more conversion and customer contractual right typically embedded within those policies, like the ability to an inbuilt contractual right to convert, let's say, a term policy into a whole of life or permanent type of policy. You reduce your ability to have flexibility around the insurance planning and ultimately the needs that you can address or the solutions that you can arrive at if you are tying your hands by having policies that don't have quite the same flexibility. Another big one is flexibility in premium funding, where in the UK it's typically annual or monthly premiums. In the US, sure, they have those options. Not that I think I've seen any of our clients pay monthly, but you might start when you're looking at indicative costs at annual premiums. But for a lot of clients, the idea, particularly if they're looking at long, permanent plans, the idea of paying premiums into their 80s isn't something that most people get excited about. And so having the ability for someone in their 40s who's working for another 20 years to structure the funding in a shorter time frame to match their outgoings with their earnings can be quite attractive.
That's one of the areas where the tax does come into it because particularly for Americans living in the UK, the desire from an American perspective to maybe fund your entire policy in one go might be great and you might have the funds to do it, but we need to think about the tax consequences of doing it that way.
Absolutely. Yeah, indeed. And I think it frankly just opens up planning opportunities because you have the rights to accelerate or short pay policies. You also have the rights to lengthen them out. You can change them every year contractually. With the US policy, you have the right to change how the policies are funded. And then obviously you have the tax consideration to layer on top.
It does strike me it's a more sophisticated, more evolved market. It's a larger market and it's a more creative market. And so you'll find more creative solutions there. And this is why B has the experience of not just this market, what I've always referred to the pure life insurance market, but also the other product-based estate planning solutions that we'll come to after a short break. Christian, thank you so much for staying with us thus far. Thank you to the audience for staying with us thus far. Do join us next time.